Hi, and welcome to the latest edition of the JMI Wealth monthly video series. Well, spring has sprung here in New Zealand, and with it we're witnessing a renewed determination from central banks and central bankers around the world to fight inflation. And that resolve was highlighted very recently in a short, sharp, punchy speech given by Federal Reserve Chair Jerome Powell at the annual Jackson Hole Economic Symposium. Now, on these reviews, we've talked a lot in recent months about inflation. It's very much a global phenomenon, although with some quite divergent outcomes around the world. But I think we can characterise all of Europe, the UK, North America and Australasia as all experiencing consumer price inflation at levels that we haven't seen in decades. One of the themes emerging in this renewed vigour of fighting inflation is the degree of focus settling upon what we call the Great Inflation Period. That ran from the 1960s through to 1980, and in much the same way that epidemiologists and microbiologists were lifted into the spotlight during the COVID pandemic, I suspect now that economic historians are going to enjoy their moment in the spotlight over coming months as the comparisons to that period start to become more widely discussed. And Jerome Powell specifically referred to that period in his Jackson Hole speech. If we look at specifically the US, inflation there started lifting through the mid-60s, and although outcomes were volatile, they were up and down, inflation in the US peaked in 1980 at over 14%. So they had a long, extended period of time of rising inflation. Now, there are significant parallels with that period of time. We've got things like armed conflicts, massive increase in government spending. This was the period of Lyndon B. Johnson and the Great Society programs. There was a series of oil price shocks, commodity price inflation, particularly food prices. And if I look at that and compare that to what's happened since the COVID epidemic swept around the globe, we've also had government spending, the fiscal response to COVID. It's in many places that's lifted significantly from spending levels prior to the pandemic. If I think back to the 70s, the Vietnam War was raging, and now we have the Russian invasion of Ukraine. There was this series of oil price shocks in the 70s, and oil has also lifted from a pre-COVID level of sort of circa $60 to being over $100 come down a little bit recently, but commodity prices have also surged. So plenty of similar factors impacting on the economic environment. Jerome Powell made three very specific comments about the stance of the US Federal Reserve in his speech that the markets have very much taken to heart. The Fed is not convinced that inflation has peaked. He said lower prints, or the lower outcomes for July are welcome, but a single month's improvement falls far short of what the committee will need to see before we're confident that inflation is moving down, and they don't see themselves stopping rate hikes soon. The Federal Open Market Committee estimates that the Fed funds rate will settle sort of between 2.25% and 2.5% in the longer run, but they've got inflation running far above 2%. The labour market is extremely tight. So estimates of where that long run neutral rate are, that's not a place to stop or pause, he said. So they'll need to keep rates above that neutral estimate. They're also wary of stopping prematurely. We must keep at it until the job is done, Powell said, and he points out that historically the labour market has tended to take a greater hit when the Fed hasn't acted forcefully and swiftly enough to contain inflation. Our aim is to avoid that outcome by acting with resolve now, he said, and this is the new favourite word of central bankers. So we're seeing this resolve being echoed by other central bankers, and we'll look for confirmation of that sort of tough stance from those other central bankers over the course of September in places like the ECB and the Reserve Bank of Australia. Now, there's a couple of key takeaways I think that will be very relevant for the outlook for financial markets. So what we're going to see in the labour market, that's going to be of heightened importance. While there also, there are some short-term contributors to the current spike in inflation, things like shipping costs. We can expect those to subside, but the more damaging factor is an uncontrollable wage price spiral. And what was also evident from Powell's comments was the role that expectations have to play in inflation outcomes. So anchoring and controlling expectations are of paramount importance. So looking ahead, central bankers are going to keep talking tough. And Powell talked about this involving pain for companies and householders. I want to make one observation about this parallel with the 70s, because actually they contain within that very exercise one of the key differentials. We now have the benefit of hindsight. So while the inflationary period of the 60s and 70s was extended, you have to assume that we come into our period fighting those circumstances fully armed with the knowledge of what the outcome could be if we don't act now. And Paul Volcker was the Fed chair that took on the inflationary fire and won, but that fight did involve a double-dip recession in the US in the early 80s. So what does all this mean for investing in financial markets? Well, interest rate markets were sort of second-guessing how tough the central banks were going to be. Now the banks have signalled that they will be holding rates higher for longer. So interest rate curves, they've moved higher in response to that. So it's also putting a larger question mark on how successful we're going to be in navigating a soft landing, in stifling demand enough to match the current constrained supply environment without sending the economy into a sort of a tough recession. So we want that Goldilocks outcome, and there's now a higher degree of uncertainty shrouding it. So we think the correct stance is to continue to be cautious, but interest rates are now at far more attractive levels to invest. So we're really comfortable putting cash to work into the fixed interest markets. We also think the local share market, the New Zealand share market, it could benefit on a relative basis from its defensive characteristics. But look, challenging times for investors, and having a sound asset allocation strategy and receiving really good financial advice from experienced professionals it's vital. And that's where we're well positioned to help. So visit us at jmiwealth.co.nz, get in touch with us so we can discuss your financial future.